the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3. Time now for Market View with me, Chua, Tian, where we take a look at how the Singapore stock market is likely to close for the day, the biggest movers, sectors and companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day trading stronger after global indices ended mixed overnight. So in early trade, the Straits Times Index climbed 0.4% to 3,816 points after some 40.3 million securities were transacted. Now, we do have the closing numbers, so let's take you through them. We do see gains moderating and the STI closing up 0.03%, rather muted at 3,801 points. In terms of value turnover, we are looking at 869 million Sing dollars. The gainers outnumbered losers, 349 versus 178. Top advances for today, we've got here Powermatic data, Ctrim and AAM. And top decliners for today, we do have here GMHUSD, DBS and Jardine Cycle and Carriage. Now, in terms of companies to watch, we do have Keppel DC Reit after the manager of the REIT announced yesterday that it will be divesting the Basis Bay data center in Cyberjaya, Malaysia, and that is for about 55.6 million ringgit or around 17 million Sing dollars. Now, elsewhere, from more on duty-free spending slumping and the Chinese holiday island of Hainan to Tesla's annual deliveries falling for the first time. We've got more international and corporate headlines in focus. And joining me here in the studio is James Cheo, Chief Investment Officer, Southeast Asia and India at HSBC Global Private Banking and Wealth. James, welcome back.
Well, very happy to be here for the new year.
Great to have you joining us today. And let's start with the Singapore stock market as usual. James, how did the STI fare today? Somewhat muted, so any surprises when it comes down to the biggest movers and the sectors that they lie in?
Yeah, well, I think the Singapore stock market is consolidating. I think it's not surprised given that 2024 was actually a very strong year for Singapore stocks. And I think clearly, it also depends on the global environment in which, particularly in the US markets. And I think there is a certain cautiousness, particularly related to where bond yields are, because of how high bond yields are. It might actually create some wobble in particularly in global markets. And I think that's where the cautiousness, I think, come from.
Which sectors do you think are key to watch for today, though?
Well, I think in terms of Singapore market, obviously the banks would be a big driver. Yeah. So that depends a lot on, economic growth. It depends on loan growth. It depends on interest rate outlook. But I think the key sector to watch out for it's actually the REIT sector, because it has sort of lots of promises in 2024, given the interest rate cut cycle. Because, in September, we've got the interest rate cut from the US. 1% for the entire 2024 since then. But if you look at long-term treasury yields, 10-year, it went up 100 basis points instead of going down. So I think that creates some headwind, particularly for REIT investors. So hopefully we get some stability in long-term bond yields. And I think if we do get that, Singapore REITs could actually shine in 2025.
Yeah, you lead me to my next question on as REITs, because in terms of the counters to watch for today, we do have Keppel DC Reit, because we saw the manager of Keppel DC Reit announcing yesterday that it would be divesting Basis Bay data center in Cyberjaya, Malaysia for about 16.9 million Sing dollars. I know you do not comment on individual firms, but as you were saying, we are in a lower rate environment, but treasury yields were quite high. So would we see more of those divestments and reinvestments as REITs recycle capital and assets, though?
Yeah, I think it's part of the business of REITs to kind of recycle their assets and of course, to upgrade their assets. And it's imperative, especially for data centers, because, now it's always the hyperscale data centers, those that, can support cloud computing as well as AI. So you, and a lot of these data centers also have, power, energy, and as well as water requirements. So I think there is a case in which, REITs manager, globally would want to, upgrade their assets to make it more lucrative, from a returns perspective, but also, from a energy kind of efficiency perspective as well.
Curious question, looking at the rate environment right now where the Fed cut 100 basis points, as you mentioned, and the Treasury yields environment, do you think it's the right time for REITs to recycle their capital?
Yeah, well, I think the clear path going into 2025 is that we are still in the interest rates cut cycle by the Fed, but it's just that it might not be as much as in 2024. So in this environment, I think there is a case for interest rates to go lower, and also subsequently bond yields should go lower. So I think it's a time where there's some short-term volatility, especially in terms of long-term bond yields. But nevertheless, I think it's still an environment where investors or even REITs managers should actually take advantage of lower yields and lower interest rates to kind of upgrade their assets and recycle them.
I see. Now, James, let's stay in Singapore and have a look at Singapore's retail sales numbers. Retail sales unexpectedly contracted 0.7% on a yearly basis in November, reversing from that 2.4% growth we saw the month prior to that. How far is this a cause for concern for the local economy, though?
Yeah, well, I wouldn't read too much into the November reading. I mean, given that, yesterday we have had a Q4, very strong 4.3 GDP number. And also, of course, retail sales December usually should pick up because of holiday spending. So I won't read too much into it. And I think my suspicion is that retail sales for December as well as going to 2025 should still be fairly robust given that the labour market's still strong here. And I think the recent data for housing prices show a fairly healthy outlook. So I think that should kind of bolster local demand.
I see. Now, if you're just tuning in, we're now in conversation with James Cheo, Chief Investment Officer, Southeast Asia and India at HSBC Global Private Banking and Wealth. Well, James, have you firmed up your holiday plans for this year, looking at the calendar with the long weekends and etc.?
It's never too early to plan. Always good to be fast before the prices go up. So yeah, I think it's a good tip from you.
Yeah, and we are talking about holidays because we're going to talk about Hainan in the next question. Duty-free spending in Hainan, that slumped 29.3% last year, where global luxury players from LVMH to Kering have set up shop. Customs data out yesterday showed shoppers visiting Hainan spending 30.94 billion yuan, around $4.24 billion US dollars on duty-free goods last year, down from 43.76 billion yuan in 2023. I know Hainan is not crucial for China's economy, so to speak, but how far is this a cause of concern given that it is where the luxury players are setting up their shop?
Yeah, well, if you put in perspective, because of the pandemic and also because of, the current situation in China, in fact, Hainan was earmarked to, encourage inbound Chinese traveling within China itself. But I think the decline in, luxury spending in Hainan is a reflection of a few things. I think number one is that the consumer sentiment in China is a little bit on the weak side, but also it's also a fact whereby you're seeing traveling not just within China itself, but more outbound travelers, Chinese travelers going outside of China. So it's a few trends playing out, and I think that's why we are seeing some pullback when it comes to luxury spending in Hainan.
And talk about a few things put together. I'm going to put three different questions together, and the questions for you, James. What are the implications on luxury players with an exposure in Hainan? That's one. The second question has to do with how will a retail sales slump hinder Hainan's plans to become that duty-free shopping hub this year? And the third one, does it bring more opportunities for ASEAN markets aiming a slice of that duty-free pie?
Well, quite a lot of stuff going on there, and let me try to unpack that.
Yeah.
Well, I think in the whole scheme of things, luxury spending, Hainan as a destination for luxury spending is around 10 to 11% of total China market. So it's not insignificant. But having said that, I would think that once a luxury maker invests in such a place, it's for the long haul. you can offset with other, other destinations doing better.
Yeah.
So yes, we might get a bit of slump. There's always ways to kind of reinvigorate and bring back spending, whether it's through new product launches or even certain discounts and things like that. So I think they'll find a way out. And I think the good news, of course, in terms of what you're alluding to in your third question is that I think there are signs that some of these Chinese tourists are actually going to the region. Malaysia, for example, has been benefiting a lot from Chinese tourists, and also we are seeing signs of some recovery in Thailand, also, which has been very much affected with the slowdown in Chinese tourists. So, I think certain things are looking quite bright for ASEAN in recent months, and hopefully this momentum carry on for 2025.
And further away, James, let's talk about electric vehicles. Tesla in question here, because Tesla reported its first fall in yearly deliveries yesterday. Because lucrative year-end incentives for its aging lineup and the new Cybertruck pickup, that failed to lure customers who are wary of the high borrowing costs. So if you're looking at the numbers, Tesla delivered 495,570 vehicles in the 3 months to the end of December, down from estimates of 503,269 units in a poll by LSEC. Now, the question is, how far do you think the competitive landscape will change in the EV market? I mean, we saw some good numbers from NIO just very recently.
I think the global adoption for EVs, I think, is likely to continue. A lot also depends on regulation. A lot going to depend on restrictions as well as subsidies. So I think those things will play out. But I think the general trend is it's up for global EV. But of course, the issue now is competition. Competition is intense. Well, in China, there are 188 Chinese EV makers. So,
188. Okay.
Yeah, so many names that we don't even know, So it's highly competitive. So whether in terms of the look, the price, and things like that. So Tesla is just one of the many brands out there. So it's the sort of competition that they face, and it's not just in China, but across Asian emerging markets, they face the same competition.
So we have yet to see the dust sort of settle yet at this point. But before we let you go, James, let's take a look at what's happening further. U.S. mortgage rates. U.S. mortgage rates climbed closer to 7%, threatening to squeeze buyers in the housing market. So if we go by Freddie Mac data released yesterday, the average on a 30-year mortgage rose to 6.91% as of the 2nd of January, up from 6.85% a week earlier. How worried are you about the ability of home buyers to repay that debt and the implications on the U.S. banking sector? And how far are these concerns contained within the U.S.? Could it spill over to other parts of the world?
Yeah, well, I think it's worth watching and monitoring, given that a lot got to do with the increase in bond yields, which I explained earlier on. But if you just look at mortgage rates and compare that with 2024, there are higher points in April last year, and it didn't cause any stress. Having said that, remember back in early 2023, we had a kind of regional U.S. banking crisis. I think the issue at the time was, in fact, a lot of banks held on to U.S. treasuries, and because bond yields went up, there was maturity mismatch. And even during that time, we did not see a sort of a stress on the housing market or on mortgages. So I think it takes a big shock for that to happen. And I think since then, I would say the banking sector in the US has become stronger in terms of capital position, especially for the larger banks. And also, I would say that a lot of the people who hold on to mortgages are on fixed rate. So, it is a risk, but I don't think that you need something bigger before it becomes a worry.
Okay. Thanks a lot for the insights as always, James, and great to have you join us today. That was James Cheo, Chief Investment Officer, Southeast Asia and India at HSBC Global Private Banking and Wealth. Thank you so much for joining us on Money FM 89.3.
Pleasure to be here.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.